Every investor must know these rules. Well, you don't have to know these rules. They're not my rules, but if you know them, you'll have much better situational awareness of what's going on in the stock market and markets in general. And they'll give you kind of a way to feel about the markets, an intuition about the markets. So, like I say, these aren't my rules. These rules were published in 1998 during the dot com expansion, the bubble expansion. So they came out at kind of the time when I think a lot of the experienced players were watching the dot com bubble expand and wondering what was going on and why their warnings weren't being heeded and so on and so forth. They didn't really gain traction. These rules didn't really gain traction until after they were republished in 2003. And by that time, everyone had sobered up from the dot com crash. And yeah, they were probably willing to take some good advice. So now you hear about these rules everywhere. Anyway, these rules were published by Bob Farrell. And Bob Farrell was the chief market analyst for Merrill Lynch for 25 years or so. After he retired or after he left that position in the early 90s, I think 1992, he published a daily newsletter or a frequent newsletter. And in 1998, he published these rules, which went unheeded at the time. So, a little bit about Bob Farrell. He was the chief market analyst at Merrill Lynch for 25 years. But before that, he got a master's degree in investment finance at Columbia, studying under Benjamin Graham and David Dodd, who literally wrote the book on value investing. Incidentally, I just want to say, even though these rules were published in 1998 and he had a long career, he pioneered things like sentiment analysis as well as technical analysis. And he was a technical analyst. And when he got into the business in the 1950s, 1957, technical analysis was still known as market timing at that point. But anyway, he's still alive. He's 92 or 93 years old, something like that. He's done recent interviews, and I believe he lives in Florida. So let's get to these rules. He called them market rules to remember. And to me, what they strike me as are market intuitions that you pick up over a very long time of watching markets and understanding markets and knowing how markets behave. And at some point, they kind of become second nature to you when you have that much experience looking at markets. And you don't have to remember these in a fashion where you spit them out. Basically, there's something to kind of internalize about the markets. So these are rules that you should just kind of internalize over time. Rule number one, markets tend to return to the mean over time. You hear a lot of people mention markets and or charts, stocks returning to the mean over time, or return to the mean. So that means returning to the average, kind of what has been average performance over time. When prices kind of diverge from where they've been on average, they over time they kind of tend to return to the mean or the norm. They don't stay out of line for too long. Rule number two, excesses in one direction will lead to an opposite excess in the other direction. So if prices go too far to the upside, you can be pretty sure there's gonna be a big correction. They're gonna go pretty far to the downside after some point if they continue in that direction. Or if markets go down for too long, too extended, you can expect a sharp snapback to the upside. Rule number three, there are no new eras. Excesses are never permanent. So this is kind of especially relevant to when this was published in 1998 because the markets were going through the dot-com bubble. And everyone thought it was a kind of a new era, you could say that. Um, at the time, Alan Greenspan was referring to what was going on in the markets as irrational exuberance. A lot of people thought it was a new era in investing, and talking about the business cycle no longer applying, and so on and so forth. So there was a lot of euphoria. And over the long term, we know that didn't work out. There's nothing new under the sun. We've seen these types of things before. Rule number 4, exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. So yes, it's essentially these gains or losses in the markets, the rises and the falls, they go on for much longer than you think. As Keynes would say, markets can remain irrational longer than you can remain solvent. So that's the thing. These upsides and downsides might run a lot longer than you think. But when they do correct, they're not going to correct by going sideways. It's going to be a snapback in the other direction. Rule number 5, the public buys the most at the top and the least at the bottom. Yeah, so the public, that's the retail investor. That's a small investor, like most of us here. And basically they get fleeced by all the big boys. The retail investor are known as bag holders. They get stuck holding the bag, usually after the pros have made all the money. The retail investors, the general public, they're all buying at the top, or they're all selling at the bottom. They get scraps. Rule number 6, fear and greed are stronger than long-term resolve. What does this mean? This is FOMO. This is fear of missing out. Fear and greed, well, FOMO is fear of missing out, but then there's panic. It's being greedy and being panicky. These things just tend to erode long-term resolve. A lot of times people hold out. It's good to have that long-term resolve if you can manage to maintain long-term resolve, where you're not doing what everybody else is doing. If you're seeing big moves in the market, you don't have the FOMO. Rule number 7, markets are strongest when they're broad and weakest when they narrow to a handful of blue chip names. So what this refers to is when you have a broad rally or a broad downturn, that signals a lot of power and maybe a lot of staying power in the direction of things. When the market is gaining and the market gets old, like an old bull market, eventually all the weaker players start kind of peeling off, and you're left with this core of stocks that are continuing to go up. For example, like the Magnificent Seven. You only have a few stocks that are making gains anymore when the bull market gets old. The same thing happens on the downside. So when there's a broad downturn, and all the stocks in the market are going down, unless you're short, that's not really a market you want to be in, because there's a lot of energy to the downside. Eventually, when it tapers, the weakest players will still be going down, but the stronger players will have stopped moving downward and maybe even recovering. Rule 8, bear markets have 3 stages: sharp down, reflexive rebound, and a drawn out fundamental downtrend. So what this is the initial sharp down. All the guys who have seen something take a sharp leg down, they all decide to jump in, and that's not the time to jump in. That's the market takes another leg down, except it might be very long, drawn out downtrend. And this just comes from experience of him watching markets for so many years. This is a pattern that you see again and again. Don't get trapped in the stages of the bear market. Rule number 9, when all the experts and forecasts agree, something else is going to happen. So this is when everybody agrees in the direction of the market. this might be the time to be a contrarian and to think something different, because especially once everyone's been agreeing on something for some time, that everything is going up, and eventually you have no more buyers because everybody's already in the market. And so um, contrary kinds of conditions are going to become right. So it might be the time to look at things from a contrarian viewpoint. Rule 10: bull markets are more fun than bear markets. Yeah, I think we can all agree on this, unless you're a perma bear who's shorting things all the time. I think he added this just for kind of fun. Well, it is fun, yes. Bull markets are more fun than bear markets. I don't know. You know, unless you're a perma bear, I don't think you could disagree with this. Anyway, these are the 10 rules to remember. They're good rules. The longer you look at markets, the more intuitive these rules will become, and they'll just become part of your being, part of your background. They're almost like the law. They're not just a good idea. They're almost like the law. I won't call them the law. They're not like the laws of physics, but they're close. They're like gravity for markets. So over time, the more experience you have with markets, I think you see these things play out again and again in the markets, and they just become a good type of intuition to have.